sure just we could start it when we're talking. Hey guys, we are here with the Commodity Report. Exciting stuff to talk about today, and there's like a million things to talk about. Of course, I get on the wrong slide on slide 1, but a million things to talk about today. But first off, Sam, how was the Super Bowl?
Yeah, Jason, it was a pretty rough weekend here in Kansas. I started out Saturday with KU getting blown out by K-State. Uh, so that was really painful in itself. And then I get to Sunday, and then the Chiefs get absolutely obliterated by the Philadelphia Eagles. They were held scoreless for quite some time. I don't think that has.
Was it scoreless the entire first half?
Yeah,
22-0 at the half?
Yeah. I just had never seen the Chiefs be dominated like that. But the Eagles have an amazing team. I have to give them credit. They have the biggest offensive line ever. Like the average guy is like 6'5" and 350 pounds.
Jesus.
I thought it was kind of interesting. They did this comparison to the first Super Bowl, which was, I don't know, 1950, 1960.
Yeah, maybe before that.
Yeah, a long time ago. But the average guy was like less than 6 foot and 250 pounds. So on average, the offensive linemen have grown by 100 pounds and half a foot over that half a century. So I thought that was kind of a fun fact.
No, you were right. It was the 60s. It was 67.
Yeah.
So
the
I
year
guess
my dad was born.
Yeah, I guess they had that after the wow, you're young. I guess they had that after the when the NFL started. So the NFL was around for many years, and then the Super Bowl came out. Interesting.
Right. Yeah. And the two leagues merged. I think the was it the AFL that
AFL
was
and
independent?
NFL. Yeah.
Yeah.
No, that's it was rough to watch at first. I was like, man, because you want to at the very least. I didn't really have a dog in the fight, but once again, I like to see a good game. But man, and OSU this year, it was very similar. We saw a bunch of games kind of like that this year, where it was like, okay, they're just blowing them out. This is kind of boring. Love to see a little bit of a tougher one. And then Nick said, you can always jump on the ASC hockey bandwagon.
Yeah, I don't think that's gonna happen, Nick.
So, a bunch of stuff to talk about today, Sam. We were talking the last week, which the China story is huge, the copper story is big. For me, it's a long-term cycle that I think we're seeing, and this is where the commodities come into play. But to talk about the commodities, we're as a person who connects the dots in too many ways like I do, we're certainly going to start outside of the commodities to talk about the commodities, and because everything's connected. If you really want to be a good macro trader, you have to figure out what's connected and why these connections happen. To me, I'm always looking at different variables, different indicators, especially cycles. What's going to tell me the cycle is kind of long in the tooth? This is one that's kind of saying it very loud and clear. I'm not saying the stock market's going to crash like most people will look at this and go, stock market's going to crash. In my opinion, looking at this kind of tells you something different. Is usually at the end of these cycles, once we hit those points, this is very tech inflation driven. So most of the time in the 60s, we had the Nifty 50 stocks. You guys heard me talk about this before. We started to top around that zone. We basically get to these low valuations, but low valuations happen because of inflation, inflation kind of taking the debt away. There's a bunch of reasons why you have these lower valuations that kind of come into play. This is where stocks kind of come back in as an easy buy, great thing to buy. Think about 2008, think about 1980, 81. And then basically you have this massive bull market in stocks for a long period of time. But most of the time, what we're seeing is we run into those zones and then the market rotates. And another thing to keep an eye on is the debt to GDP ratio. So I don't know how best to explain why. So something you have to always think about when you're looking at markets and you're looking at debt is to understand that the only way to really get rid of debt is inflation. So if you think about it, like let's say you loan somebody $100, and if you give that loan about $100, and then let's say inflation gets out of control and the cost of living is twice as much, $100 in debt is not as painful to repay. It's kind of the same thing for the government. It's the reason why they just kind of keep inflation going after all of these years and just going, going, going. 2% inflation rate. Why do we have to have any inflation rate? That's the question nobody asks. And really, it's we have to get rid of the debt. And so that's why the rate of inflation is always at 2%. But what if we have, all-time highs in the debt to GDP ratio? What if we have more debt than we've ever had in history and we can't pay it back? Well, we need to inflate it away. Hyperinflation, which I think is the technical term or the technical way to look at that, is 50% inflation per month, month over month. So if you're looking at that type of inflation, we could actually get rid of our debt in about 6 months. And once again, I'm not saying hyperinflation is coming tomorrow. I'm just saying the only way to get rid of this amount of debt is inflation and keeping the inflation rates high, and even moving them up from their 2% target to 3%, maybe to 4%. This is going to probably happen going forward. Yes, they're not going to move it up today from 2% to 3%, but I'm saying looking into the future, this could happen. And so, Sam, when you look at this chart, what really sticks out to you? Because everybody's heard me explain it once. Because I keep bringing this chart up because, man, it's spot on. So, what are you seeing when you see this chart?
I see gold and silver dance together. I think you could even throw copper onto this chart. But these precious metals, base and industrial metals, they all dance together. And we've seen gold lead the way higher. You can see on this chart, something that stands out to me is that gold tends to lead the way and then silver follows. But you can go down the line, talk about copper, talk about aluminum, talk about tin, talk about rebar. They all follow gold's lead. And I think that's exactly what we're seeing play out in real time here.
Yeah, I agree. I think we're going to see this silver, you call it the catch-up trade. I hate that term. I think
It is what it is, though.
It is what it is, but you can call it the catch-up trade. I just have problems with things that sound ridiculous, and that's my brain. It's not about, it might be just old set in my ways. I learned to trade from a very old trader, so you hear a lot of old terms come from me.
So what do the old traders call the catch-up trade?
We'd call it so what my great uncle used to call it is relative value. So if you look at something like relative, for example, if you're looking at 2000, the era we're talking about, you look at the move in 2000 and you'd say, okay, what's the relative value from gold to silver? Or what's the relative value from the stock market to gold? This would be the relative value, and then you'd look at the relative strength. So, I once again, I understand the term. It does make sense. However, for me, I'm still stuck in the old term ways. And just once again, it's to each their own. If they like the term, it's great. My biggest thought about this is if you're looking at this chart, silver is definitely the next thing to catch up, and that move could be massive. And I think everybody's kind of written off the $50 silver, but I think that could happen very soon.
And I don't even think we're talking about $50 silver, but potentially higher. We need to get to 50 first, but that's not my target by the end of the cycle. I think we see triple-digit silver by the end of the cycle. Like if gold's going to 8,000, like I think it is, why the hell would silver just go to 50? It seems pretty low to me.
No, I agree. It's one of those things that you absolutely have to understand that silver going to 50 is probably low. And you and I talk about this all the time. When we go back and look at what our targets were for a lot of these things, we're going to laugh about it in a couple years. Because $50 silver, everybody looks at that chart. We brought that I brought that chart to the event we did, and seeing that chart and looking at it and going, oh, okay, well, here's what silver's doing. And here's where the breakout zone would be. And here's what would happen if we get above $50. And everybody goes, well, I've seen that chart a million times. Sure, but it's still a chart. It's still telling you there's a massive cup and handle pattern that's been building for many years. We saw the same thing happen in coffee. Coffee looked very similar, and then coffee broke out and continued to move higher.
That's a great point, Jason. We've seen cocoa do the same thing.
Gold, cocoa,
Gold, yeah.
you go down the list, and it's what I really hate about when people look at markets is when they look at it and they think because something's been going on in the past, it's going to continue that way in the future. And that's just not how it goes. Look at gold from basically 1980 all the way to 2000. It did nothing. It did absolutely nothing. It didn't make anybody any money. It didn't do anything. And everybody at that point wrote off gold. There's very few gold bugs at that time saying, hey, I want to buy gold. Most of the people who got into gold that are around today are people who started buying in 2008 or buying it in 2011. So, at that time, nobody cared about it. Nobody thought it would go higher ever again. Next thing you know, it's moving higher. At that point, it was technology stocks will lead the way forever and ever and ever till the end of time. And if you're an idiot if you don't own all of the technology stocks because gold is a rock and technology is the future. And once again, I'm not hating on tech stocks. Own them. There's plenty of times to trade them. I'm just saying it looks like there's a better trade happening right now in the precious metal space or the commodity space.
Jason, would you mind pulling up slide number 11? I think this ties into our conversation we're having here.
Yeah.
So what we're looking at here is gold relative to the S&P 500. So gold relative to the equity benchmark. And what you see here is this level that we're currently consolidating at has been incredibly important in history. In 2003, this level was resistance, and then it was flipped into support around the Great Financial Crisis. And you can see that we've just been churning sideways here for several years now. But as you can see on the upper bound of that channel that I marked up there, we're pressing against that. And in the lower pane, you can see the monthly PPO. This is a long-term trend indicator. It's basically just the logged version of the MACD. If you all are familiar with the MACD, it's very similar to that. But the zero line is very, very important on these indicators. You can see that once you're above the zero line, you tend to stay above there, and that level tends to serve as support, and vice versa. Once you're below the zero line, you tend to stay below there and find resistance at the zero line on any corrective waves. However, we have been consolidating right at that zero line for years now at this point, and we're just now starting to pierce through it. So that, in my mind, is a fresh buy signal, and overlay that with the chart here. I think this makes a lot of sense to break out and make new multi-year highs, and I think gold's about to start a fresh uptrend versus stocks. So what does that mean? I don't know. It doesn't really mean you need to sell all of your stocks. It could be everything continues to work, but tech struggles, which is a large component in the S&P 500. So it doesn't necessarily mean sell everything, but I think it does mean we need to think differently about stocks relative to gold.
No, I agree. And this is where the relative value idea comes in. And if you look at this in Sam's chart, go all the way back to 2000. If you think about it, gold has actually outperformed the S&P 500 since that period of time.
Yeah, it has.
A lot of people don't think that, but this chart actually is saying that yes, it's underperformed from 2010 to 2025. However, it still has been in a bull trend to the S&P 500 this whole time. So once again, I'd say right with you, Sam, on this. This breaks out. I would think, yeah, it's not a stock thing. It's not a, hey, all stocks are going to go down. It's, hey, we have a over 50% weighting in technology, meaning XLC, which is communications, meaning XLK, which is technology, meaning XLY, which is consumer discretionary. These are the three biggest sectors in the S&P 500 at the moment. And so if we can kind of get this to move a little bit higher, I think that just means technology is probably going to start going the other way. I think material stocks could be awesome here. I think
They've done nothing for years now. It would make a lot of sense to see some rotation into materials.
materials, what's the other one? Chemical stocks inside of materials actually are doing pretty well. So I think there's a lot of things that we could get out of this chart that could be doing well here.
Absolutely. Not to mention energy stocks, which we've been talking about for some time. They've done absolutely nothing. You can go back to the Great Financial Crisis, even, and energy stocks have done absolutely nothing. Um,
Yes.
we've recently seen financials outperform dramatically, and until that happened, you could say the same thing, that financials have done nothing for a decade. But they have reclaimed that Great Financial Crisis level, and they're making new all-time highs in a lot of cases. So I just think energy is the next logical step. So is chemicals, materials, on down the line.
No, I agree. It's energy is probably the hottest thing here that is so beaten up, but also within a primary uptrend. That's the other thing, people don't talk about right now. Energy is actually still in a primary uptrend. We haven't hit a new 52-week low in a long time. We're looking at this as it could move higher here, but it's just been consolidating forever. And as this thing continues to consolidate, we need to be ready for that breakout. Because if you're looking at the rest of the underlying commodity complex, you're seeing this same thing happen again and again. Let's get back to, if we go back to here, let's get back to, so let's look at the whole commodity complex. So I put a couple in here, the ones that Sam is going to be excited about too, which is we got gold and we have copper after this. Gold sitting at a new all-time high. Now it's funny, and this is what I love about Twitter, is the sentiment check. Just the other week, I made a post which is, hey, this is the next leg up in gold. A bunch of people. I got one person that really wrote some nasty stuff, but then a bunch of other people just kind of were like, no, you're trying to buy too high here, and that's, once again, I love hearing that, because there is no such thing as buying too high. You don't know when something will stop. I wish I did, when something will stop or when something bottoms. Yeah, that'd be great. It's just impossible. Nobody knows that. It's a guess. What you do know is that when something breaks out or moves out of a flag pattern, I've known tons of traders who've used nothing but flag patterns over the years to just buy and sell things, and they have great returns. So you can use this flag patterns like this. So gold made a huge flag pattern up here. It broke out. That was, I think, around 2,700, Sam, right? And that was your buy signal as well for your Fibonacci extension. So
Right.
it gets over that 2,700 level, and it's over 29, and it's probably continuing up to 3,000 pretty easily. People keep sending me this chart from Peter Brandt and going, yeah, a lot of the times gold stops be right before those big numbers. That's also looking back and going, okay, did gold break out of the 100 zone and the 200 zone and the 300 zone and just continue to move higher there? Yeah, it did. So, yes, if we look at thousands, sure, it's kind of stopped a little bit ahead of the $1,000 level and the $2,000 level. But if we're looking at this as the beginning of a new move and we're seeing that huge cup and handle pattern, we're really targeting something like 5,000. I'm not saying it can't consolidate here. I'm not saying it can't consolidate around the 3,000. I'm saying the amount of market cap that we're at right now, 3,000 is a chip shot. It's a little move at this point. The next move is probably 2,500 should be actually the next target. Do you have some targets, Sam? Because I know people love to hear targets. I'm not a target guy, but Sam kills it on the targets.
Yeah, I'm just a big Fibonacci guy. I can pull up my charts here, get you some exact numbers.
Mhm.
But you were right with that 2,700 level. That's a big one.
Yeah, that was a
Um,
fib extension that we got over, and then we continued, and that's another thing. We talked about the fact that it was probably going to stop there, and then it stopped. It consolidated, but we weren't not bearish on it. We actually, when there was a dip, we continued to say to buy that dip. Gold is it, people are looking at this, and they've never they we always say that it's a very old phrase. There's no fever like gold fever. And what that means is if you look back at that 2000 move, that's a normal run in gold. If you look at back at that 70s move, that's a normal run in gold. Gold makes huge moves, and it doesn't have a tendency of looking back or consolidating much within that trend. Yes, there's periods of time like recessions, liquidation events. That's the thing that happened in the late 70s and in 2008. People basically will sell anything that has value for dollars to cover their margin calls and stuff at a certain point. For those of you who've been trading for a few years, a current example would be 2020. Everybody sold everything at a certain point. Gold usually goes down the least in those scenarios, though. And so now going forward, if we're looking at that 2000 move, this thing could be 10,000. If it makes a similar move, it could be 10,000. Now it's a bigger market cap. So once again, I'm not saying it's going to be an easy move. I'm saying looking at something like 3,000, 4,000 is probably a pretty easy hit. So what were you seeing there for the fibs, Sam?
yeah, for sure. So first of all, just like my thesis for this entire bull market is it's going to look a lot like the 2001 to 2011 bull market. So from that 2001 low, you rallied 650% to the 2011 peak. So if we rallied 650% from the 2015 low, that would give us a target of $8,000 gold. I think
Hmm.
that's pretty reasonable to see the next few years here. I'm not sure how long it's going to take, but maybe 5 years is a reasonable time frame for that. And then just more short term Fibonacci, 2750 was the big level. You found resistance there in October, consolidated there for several weeks, and then we've recently started a fresh leg higher with an initial target of 3,400. So I think we could see $3,400 gold within the next 1 to 3 months.
No, I like that because it's too many people are thinking that this is over. And I think that's a ridiculous thought because one, it's a trend. Anything that's trending, I'm not going to bet against. That something that's been on my mind lately is people always talk about people getting hurt in the market. And they're like, when this thing fails, when technology, what everybody's talking about now, when technology fails because of the valuations on all these other things, people are going to get hurt. And I always tell people, what hurts people? Telling them to bet against a trend, telling them that something is high and you should just short it because it's high, or you should be out of it. This is a trend. We're in a commodity cycle. Gold is leading the way once again. It led the way in 2019, 2020, and it told us that the 2020 and 2021 were going to be huge moves in the commodities market. We got those moves. Now it's saying the same thing again. And we're looking at these other areas here, and Sam loves this one, which is copper. So copper made a new 100-day high recently. People have been asking me a bunch about this, so I'll go over this real quick. So the old turtle trading system, there was a few different strategies that they used. Some of them you can't really use today. They're more short term. 20-day highs, 20-day lows, like Richard Donchian style, going all the way back to the Depression. You can't do that. You can't trade those. Those don't make money anymore. Buying a 50-day high, selling a 25-day low. Yes, once in a while that system will make money, but over the long run, you will not make money. But one of the other methods that they use, which is a little bit more longer term, which is 100-day highs and 50-day lows. This is actually still a profitable system, profitable strategy. It does create positive expectancy across all asset classes. And if we're looking at copper, copper's made a 100-day high. And if you're looking at this chart, copper buying 100-day highs, selling 50-day lows, you actually made a little bit of money on that one that looks very choppy there in 2022, 2023. The next one you made money on, which is in 2024, that huge move that we got, it was like a 40% move or in just a few months. So that was a massive move in copper. Now we're seeing another 100-day high. So this one is the one where we've been consolidating. We have this massive top. I really think if we get a close above that $5 level, I don't think this thing's going to look back. And you had some targets on this, Sam, which you were talking about, and people said that that's impossible. And I'm here to say that I agree with Sam. This could go on be a lot bigger move than anybody's thinking. I mean, look at that move from 2020 to 2021. Like, it's just staring you in the face, and you're like, yeah, it probably can't do that again. No, it can. Copper absolutely can move.
I would say it's probable that it does that. I would be surprised if it doesn't rip like that again.
Yeah. It's just the commodity complex. People always ask me on here, Jason, what would you do if you had to buy 4 commodities and hold them all year long? And which ones would they be? And I always say I wouldn't do that. Commodities are trading vehicles. I think that, yes, they will go up in this year. But once again, it's how are you going to get in and out if I just sit here and go, well, I'm just going to hold it for a 1-year period of time? Think about something like Bitcoin. It could go from 100,000 to 200,000 back to 100,000 by the end of the year. You don't want to just sit there and go, hey, I'm going to hold on to anything. Same with copper. I want to have a system or a strategy to get me in and out of these things, whether it's buying a 100-day high and just using a trailing stop, whatever it is. You want to have some form of protection there. And I think a trailing stop loss is the best way to do that. And if you are going to buy a basket of commodities to just hold in your portfolio, look for something. Sam called it out too with me last week, which was DBA. DBA is a good one to just hold for a long period of time. But no matter what, commodities are trading vehicles. They're not something that just go up. Gold's the only one that kind of really holds value over time because of it's a monetary metal. But copper, this thing's going to move. It could be a huge move. It could be a 100% move, but it could come back, 50% at some point as well. So use a trailing stop. Be smart about how you're trading these things. So next one I want to talk about is the dollar. So Sam, I talk about the dollar way too much. I think but also it's one of the most important things in the market. And the cycles of the dollar is kind of what I want to get to today. Now, I learned how, to run cycle charts a long time ago. I love cycle charts. However, I also know it's very hard to trade them. This is very long-term cycle. How exactly would we trade it? So what I'm saying here is we're probably headed into a weak dollar period. And being in a weak dollar period, we have to look at ways of trading that weak dollar period. Like, are we just going to continue to, go long all the things the market tells us to, that people think that you should be in? Is technology going to continue to work in a weak dollar environment? Historically, that hasn't been the case. Usually, technology does well in a strong dollar environment. Think about the late 90s. Think about this run in technology from 2011 basically to today. And then the nifty stocks I talked about in the 70s. So that strong dollar environment is usually good for technology stocks. But what if we're in a weak dollar environment and the whole market is catered to a strong dollar environment? We were talking about it the other day, and I think Rick went on and did a bunch of research because JC was like, how many bond ETFs are there? I was like, I don't know. There could be more than 100. And he was like, no way. And then Rick looked it up, and there was like more than I even thought there were. There's probably 1,000. So once again, you have all these managers just dumping money into these products over the years, and they're not dumping money into other things anymore, like cocoa.
This is such a great chart.
Yes. And so Rick and I had this idea, which is we were going to, kind of highlight these and basically what I wanted to show is the fact that most of these things were made in the 2000s. So we had commodity ETFs in the 2000s. This is cocoa. As you see, cocoa made a huge run basically from 2000. I mean, it was a massive run from 2000 to 2008. And
Well,
then
that was
right
the
at the
last super cycle, right?
yes, there's the last commodity super
Like,
cycle.
when you saw all these ETFs come out, that was a pretty good time to think about selling. You know,
Yes.
it was the same story for gold miners. I think it was 2008 when they launched the GDX ETF.
Yep.
Check my math, but I'm pretty sure that's accurate. And that was pretty close to the top. It's just a sentiment check, I think.
Yes, right near the top.
Yeah.
And,
So they
and you're right.
delisted it right before it ripped. You know, that's perfect.
It's common, you know, it's common in the market. And once again, it's our psyche as humans, and that's why I always talk about mindset more than anything else, because you know you have to really fight thing yourself in the market. You're not fighting me, you're not fighting other traders. People think about it that way. Oh, there's the smart rich guys who were out there and they're screwing me over. It's like, no, you're fighting yourself. Like that's who you look in the mirror every day, and that's the person who is destroying your trades. Because look at that chart right at the top. Hey, let's come out with a commodity ETF. We'll dump all of our money into it perfectly at the top, and then go straight in a range where you basically sell at a loss at 2400, and then cocoa explodes. Cocoa becomes one of the hottest things in the market. The ETF would have actually done even better because of the way the curve was in the futures market. So you'd actually got paid to roll into the future. So the ETF would have actually been above and outperformed cocoa. So right at that
That's
point,
interesting.
you basically get a delisting. So this happens again and again. Coal, Sam's been talking about coal a lot lately. So if we
This
look
was
at
the
coal,
best performing industry group in the last cycle. Not a lot
yes,
of people know that.
yes, it has made a huge move. So look at the custom coal index compared to it. So basically, same thing. We get to 2020. Hey, I've been being beat up in these coal stocks. You know, probably their AUM just dropped to nothing. There's no liquidity in the coal ETF. Basically, it gets delisted, and then it makes a huge run. So mainly what I'm pointing to here is the fact that what's really left for traders to really get into to take advantage of a commodity cycle, there's not much in the broad ETF market. But if you look at futures, there's everything. Everything is still there to trade. You know, what you want to be on the SGX, you can trade things like coal and rubber and iron ore and different things. You want to be in the US markets, all of these commodities that we're talking about, cocoa and so on, those are also still listed. Does coffee even have an ETF anymore? I know Joe went away.
Yeah, I
Um,
don't think so.
yeah, so you know, you got to kind of get into these different areas, and if you look at the coffee contracts, KC is a U.S. coffee contract. It's pretty large. I think it's around $100,000 now. But if you look at Robusta, that's much cheaper. So look at these different areas and kind of find like, hey, there's minis and micro contracts in the future space. Soybeans have mini contracts. Corn, wheat. So there's a bunch of mini and micro contracts. So if you're looking at this and learning anything from what I'm talking about here, it's hey, probably start to look into these markets in the future space. Open up a futures account, try to get an understanding of how this is going to work. Just in case, because really that's where the money's going to be made. Everybody always talks about the certain trades I've had over the years. Oh, it was you did this, you did that. Yes, that's cool, but the only way that any of that's possible or my returns are possible is because I'm in futures. Finding those areas that there are things, and I also have a belief that the past isn't going to look like the future, so I continue to look for these different areas to buy going forward. So, Sam, have you been paying attention to lumber?
I don't follow this market very closely, but I do look at the chart every week. It's shaping up quite nicely here. I haven't been looking at this Bollinger Bandwidth. I'm glad you included that. That looks quite squeezy.
Quite squeezy. That's the truth. So when you look at this chart, you see there was a head and shoulders pattern basically last year, inverted head and shoulders, and then we had a really nice squeeze that was on a daily chart. This is a weekly chart, And then we broke out of that little squeezy pattern. And then we've just kind of been hitting our heads on this resistance over and over again, going back all the way to 2023. And so, lumber is still having supply issues. And lumber has a lot of reasons to say, hey, this thing could go a lot higher here. It comes under some pressure when yields get very high sometimes, meaning housing market, meaning yields, meaning lumber. So you add those three things together and you can understand why lumber's under a little bit of pressure. However, if you look at lumber and this thing really breaks out of this range and you're thinking that yields are kind of going to chop sideways here, lumber could be the thing that really makes a huge move. I have never seen a market this dead in the commodity space. I said something the other day about Bitcoin. Will it ever get out of this range? I just made a joke about it, posted it on Twitter, and somebody said, yes, it will stay in this range forever. And just that somebody else wrote a sarcastic joke, which is awesome because nothing stays in a range forever. And commodities very rarely stay in a range. When you see a base like this is something to have on your charts and take a look at. The LBR chart for futures is actually very liquid now, so you can trade it, but this has a lot of other implications.
So
So,
they changed those contracts. You wanna talk about that for a second?
yeah,
Didn't they change that to make it more affordable? Like, it was, I don't know, $100,000 for one contract a few years ago, and now it's 50,000. I'm just making up numbers.
yeah, no,
Isn't it
they
something
cut
like
it
that?
basically in half. Yeah, you're right. They've cut it. So the LBR contract is much smaller now. You can basically get in and trade it very easily. It's a lot more liquid now. So there's a lot of reasons to look at this and go, okay, well, lumber should be on my watch list these days. Before, at a big contract, there was only a few people large enough to trade it. However, there was another problem. Once you got to a size too large, you couldn't even trade it anyways. So because it was too illiquid. So there was a bunch of reasons why you could and could not trade it. So it's an interesting product, but it just has a lot of implications for different areas. The wood ETF, I used to talk about that one a lot. I haven't talked about that one in a while, but things like International Paper, Warehouser, box factories. If you're looking outside and you're seeing the fact that Amazon is coming to you, your neighbor, and your friend's houses 50 times a day, we're probably using trees. We're probably using wood. So, keep an eye on these countries. Keep an eye on lumber. Keep an eye on those companies that we're talking about. Um, oh, Sam tossed this one in here. Let's see. What are you talking about, Sam?
Yeah, no, I think we were talking about the weaker dollar, environment here, and I think this speaks to that, look at this euro, COT positioning.
100%
This is
still.
about as extreme as it gets, and I don't know if you can pull up the chart. I'm sorry to um,
No, I
impromptu
can.
like this, but I think that would be helpful for our viewers to see. Back in, I believe it was 2022, you had this same positioning right before you had a pretty significant decline in the value of the dollar.
I never look at the euro on here anymore either. So let's take a look at the euro. Let me pull up. On a weekly?
Yeah.
Uh,
So let me pull up my COT positioning. Give me just a second. So it was back in let's call it July. In July of 2022, you saw the same positioning we have today, which is about as extreme as it gets. And by the time you got to the end of September, early October, you saw a pretty significant reversal there. So that's what Jason's pointing out on the chart there. That's where the positioning got extreme in July, and then when it bottomed, they started to unwind to that positioning, and then you got that face-ripping rally in the euro. I'm not saying that needs to happen again, but I wouldn't be surprised if we saw something like that. From false moves come fast moves in the opposite direction, and I think you have
absolutely.
a potential failed breakdown in the euro right now.
Absolutely. No, I love that. Because if you look at it, when did we start seeing this extreme positioning? It was November. November, we started seeing this very extreme positioning right as the dollar broke out. And once again, when you see that type of extreme positioning, there's probably not much lower to go in the euro, not much higher to go in the dollar. And so that reversal, and this is a systematic way of looking at it. Jason Shapiro looks at this. A lot of different people look at the COT reports to find reversals in the market. So we're just looking at this here as, hey, we did see extreme positioning, but I also want to see some momentum behind it. We're starting to see it, but what I really want to see is the euro get back in the box. If the euro gets back in the box, I think it's going to go right to the top of the range pretty easily. And that level is right here at 105, 105.2. So 105.2, that's the point you want to continue to look at and see, okay, can we get over that level? 105.2 basically even. If we can get over that level, I see no reason to think that the euro can't hit the top end of that range and the dollar can't hit the bottom end of its range.
And that could happen fast too. Like that could just be one weekly candlestick, if we get
Yes.
some, I don't know what the catalyst is going to be. Maybe some economic data, some dovish Fed remarks, something like that.
No, I agree. And so it's looking through this whole thing, and we've seen all of these currencies here have hit 100 in the last few months. So we continue to see this amazing amount of buying. The Canadian dollar was one of them. The Aussie dollar is one of them. The New Zealand Kiwi was another one of them. The Swiss franc hit 100. So all of these have already hit 100%, and they're coming off of it. And that's usually when the moves happen. So I think that there's no reason to think that this can't hit the top side of the range. I'm glad you brought that up, Sam.
Yeah, for sure. This is an interesting chart right here. So I grew frustrated with the GDX ETF because it just sucks so bad, and it holds so much Newmont, and Newmont it sucks. It's gone absolutely nowhere since I believe 1987. It had a pretty good blow off top. Uh, um, so with that frustration, I created this index to get a better insight into what's going on with the
Hey, can you guys let me know if you can still hear Sam?
Hey, sorry.
Okay.
Can you
He
hear
went
me?
off again. Say something, Sam.
Test, test, test.
Okay, I can hear you now. It looks like
Sorry about
you're hitting mute somehow.
Yeah, sorry about that.
No, you're
I
good.
didn't mean to do that. Where did I stop?
You were talking about Newmont.
And how much it sucks?
Yeah, and how much it sucks.
So since I'm not sure if all of your viewers are market historians like we are, but back in 1987, there was a pretty good crash in the market, and Newmont fell victim to that, and it had a pretty significant blow off top at that time. And Newmont has gone absolutely nowhere since then, and that's about half a century. That's a long time. Um, so with that in mind, the GDX has an outsized position in Newmont because of its market cap. So I created this equally weighted index of the top 10 market cap names in the gold mining industry. So that's stocks like Agnico. Newmont also made the cut because it's so big. You had Wheaton Precious Metals, you had Royal Gold, Pan American Silver, Kinross, all of the big boys. I think most of us know those names. But if you look at the GDX, you can see that it's nowhere near that prior cycle peak from 2010, 2011. But if you look at it like this on an equally weighted basis, you get a really different picture, and you are pressing against the prior cycle high. And last week we closed above it for the second time ever. After I think it was late October, you closed above there and quickly failed. The bulls stepped up and are continuing to drive these prices higher, and I think this just speaks to precious metals bull market. Like we've seen gold take off, we've seen silver break above that $30 level, and to see risk appetite spread into the gold mining industry just reiterates that theme. So that's really what's going on here.
No, that makes sense. And so if you guys have questions or comments, feel free to write in. We can cover whatever you guys want. We got about 10 more minutes. But no, Sam, that's spot on. And I think when we look at AEM, NEM, once again, somebody was asking me the other day, hey, should I buy Newmont or should I buy AEM? And they were telling me that Newmont could do better for all of these reasons. I was like, yeah, I mean, sure, but the chart on AEM looks better. The company looks better underneath it. Newmont has made very questionable management decisions for many, many years, over and over and over again. I'm not much of a fundamental guy, but a bad management team isn't a good thing for a stock. It
And I
never is.
think you kind of are a fundamental analyst. You follow the price, and
That tells me the fundamentals.
the market is the best fundamental analyst. So if you're listening to what the market says, then you are by definition doing some type of fundamental analysis. Maybe you're not digging into the balance sheet of Newmont, but you are looking into the company's operations and
No, for
in
sure.
a way.
And I think it's a good point, because for me if you are looking at the management or if you are looking at any fundamentals, the thing that's going to tell you if you're right or wrong is the price. You can say, hey, Newmont has the word. I could say today Newmont has a very bad management team. But if Newmont broke out to an all-time high and started being the outperformer and had relative strength, it would tell me that something's wrong with my analysis. There's a great story. If you guys go to the YouTube channel, there's a video with Trader Victor Sprandio, and he talks about anchovies and talks about like a guy trying to buy anchovies. And basically, the idea behind it is, hey, this guy thinks he knows everything about anchovy prices in the entire world, but anchovy prices are continuing to crash, and that's telling him that something's changed. And really, that's the big thing about anything you're looking at in market is you can have the best fundamental view. I'm a macro analysis guy. I love to have a big picture view each year coming in. I love to look at cycles, all of these things. But if the price isn't matching up with things I'm saying, it's the reason why I keep talking about. If you guys are on our Substack channel, so it's at AEO Research. Yeah, you guys can sign up today. We put out a lot of free stuff. If you guys aren't paying subscribers obviously get more. But if you go to that, we continue to talk about this big picture view of inflation. But what I keep saying is our returns were so good in month one that it's telling me that we're positioned properly. And so being positioned properly is everything. And once again, I don't care about the returns for month ones to brag about it to you guys. I care about it because if it would have been down, I would have thought, hey, I'm probably wrong about any of the things I'm thinking. Because once again, the price action tells us all we need to know. So, like Sam said, it's the best fundamental analyst out there, because you not only can have an idea, but you can fade your own ideas just based on the price action. And a lot of the time, I think that's something we were talking about, fighting, self against self as a trader. A lot of the time, you coming in here and going, hey, like I have this, like for myself, I've had really great ideas, I think, in my head. I'm talking about in my head alone. My ego tells me this is a phenomenal idea, Jason. You're one of the smartest people on earth. My ego's telling me this over and over again. And then I have to look at it and go, I'm getting my ass handed to me in the market today because of my ego telling me that I am really, really great. And so let's say the signal goes the other direction. At that point, you have a choice. You could fade yourself, or you could continue to hold on and hope. Holding on and hope is a way to lose money. So you sell your position, you wait for a short signal, and you go the other direction on it. And for me, that's why the price action always overrides everything I'm thinking, because at the end of the day, I don't know as much as the market knows. No matter how much you think you don't know anything compared to what the market knows. And the market will tell you how you should be positioned or not positioned. And it'll make a fool out of you if you think you know too much every single time. Nobody is smarter than the market. Nobody is even smart in the market. And we all talk about this. There's no such thing as smart money. It's all dumb money. So you got another one on here, Sam?
I'm not sure. Let's see. No, this is all I brought along.
Okay,
But
perfect. So
put
let's
together
go.
some charts if you want to see anything.
No, we're good. I think we're almost done. If you guys want to see something, you guys could write in and let us know. So let's go. My screen froze.
Shout out Nick hanging out in the chat with us.
Nick's the best.
Nick's the man.
Nick's gonna come on some more because he has some really good analysis. We got to hang out and get breakfast one time. This guy really like understands the business cycle like nobody I know. So we're gonna bring Nick on some more going forward.
That's
Uh,
something I don't pay much attention to, but
he's very good
I
at it.
know it's very, very valuable. It's just not something that's in my process. So I'd love to hear from Nick. That
Yeah,
would be
he
awesome.
really has some good stuff on that cycle. So we'll end on this one, which is I just want everybody to kind of take this one home with them and kind of think about the commodity cycle this way. If we're talking about gold rings the dinner bell for the commodity cycle, silver absolutely tells you if you are in a commodity cycle or not. If silver is going to move and make this big move, which I absolutely think it is, I think it's going to take out 50 probably pretty easy. The highest close was around 43, I think. So the highest close ever for a monthly close was around $43, and that's what you're seeing there in 2011. I think we could see something around that zone pretty easily here within the next couple months. And then once we start to get over that, if we get a close over 45, I'm thinking this thing's going to hit 60, 70, 80, something really crazy pretty quickly. And then once again, you got to ask yourself this question if you want to be positioned. And that's the thing I keep talking about on Against All Odds research is we would just want to be positioned properly for what's coming. And being positioned properly for what's coming, if you think silver is going to move, if you're a person who's starting to buy silver and you're starting to buy copper and you think these are good, and China also looks really good. Most of these things all kind of move together. So if you're thinking all that's going to happen, there's no reason to start thinking, hey, I need to really look in the commodity complex and find other areas. There's all different ETFs for that. You got the corn ETF, which is actually just corn, CORN. You got soybean ETF, which is soyb, so SOYB. You've got wheat, which is WEAT. You've got the DBA ETF, which is a lot of these commodities, softs, and ags together. You've got the cane ETF for sugar, CANE. You've got DBC for energy-based commodities. I mean, USO for oil, UGA for gasoline, GLD for gold, SLV for silver. It's endless. PPLT for platinum. Is that still it? I think, yeah. And
Yeah.
PALL for palladium. I mean, I could go on, but there's a lot of ETFs out there in a lot of these areas. You options traders out there, stay away from the options in them. They're pretty illiquid until this cycle really kicks off. So I would just, buy these for some exposure to something different than just holding. And that's the biggest thing I'm just trying to give to everybody today. You don't have to sell your technology stocks, but you do have to start looking at these other areas of value for a move that's probably coming.
For sure. Yeah. I think there's a lot of opportunities that are more fresh, like energy stocks, like precious metals, more so than stocks like Nvidia that have already rallied 10x this cycle. Give that
Well,
one a break.
let's look at some of these actually before we go. So I want to take a look at XLE because we were talking about that earlier, and people were probably curious what the heck I'm talking about because this is the difference in trading. So if you look at it, I never go to daily charts, so I don't even know how old these annotations are at this point. But if you look at a daily chart of energy, this looks terrible, horrible. Would you buy this? It is making higher highs, higher lows, kind of, but
It's a range-bound market.
it's a range-bound market. You really don't want to buy it. But this is also the time frame I trade. I held my trades 6 months to a year. So if we're looking at that, we're looking at a much different look here. So basically, and a lot of people don't know this, during Biden's term, the best spider sector was energy. So people don't think that. They would think technology, they would think something else. No, it was actually energy. Technology was in a huge drawdown in 2022. Energy really kind of based and held up pretty well. It actually ended the year 2022. I think it was over 50%. 2021, it was an insane move. So basically, what we're talking about here is we get to 2020 and the way when did his term start? So it'd be here. Yeah, that was that election. So we got 188% return in Biden's term. And I think technology was just behind that. And I don't even think it eclipsed 100%. So once again, it's a look at these areas because they do make huge moves. And as traders, it's not about like, hey, I'm buying and holding for 5 years. Yes, technology does well. Or okay, are you a trader or a buy and holder? If you're a trader, look for these different areas because if this thing really and it's hit these levels a bunch of times now, it's tried to break out a couple times. Usually, the more hits, and this is old school technical analysis, the more hits to the top of a resistance zone, the more chance you have of it breaking out of that zone. So we continue to kind of bash up to this zone over and over and over again. So right now, what I'm saying is, and here's the actionable trade from it. If we get above 98.82, get a close above 98.82, so a close around 99. This thing's going to take off, and that's your breakout signal for the one of the longest consolidations and something that doesn't consolidate for long. Commodities and commodity-based sectors do not consolidate for long periods of time, but when they do, that creates an explosive move, either higher or lower. So the XLE ETF is a good way to take advantage of it. I also like XOP. It's another good way to take advantage of it. The buy signal is above 149.49. So, 150, it could be a very simple number to keep an eye on. But continue to look for these areas because there's going to be a move that's going to happen at some point, and that thing's not going to look back anytime soon. Are you thinking of anything else in the energy sector we should show people, Sam?
Not at an ETF level, but
I know. Go. That's why I figured individual stocks.
I really like coal. We were talking about coal earlier, and if you look at something like ARLP, this is one of the best setups in the coal space.
Ooh.
This one, it's not just attractive in absolute terms, but this one also pays a pretty monster dividend. It's about 10.5% currently. So that is almost twice that of the bond market, which is very, very attractive to those that are looking to collect some income.
No,
So not only can you get like 30-40% out of this one in the next 6 to 12 months, in my opinion, but you can also collect 10.5% income. So I think this one's very interesting.
No, I love this idea here because look at it. I mean, it's breaking out and then it's just kind of sitting on support. That's really, really good. And then let's go one more long term before we take off. So long term CCJ.
Yeah.
This is the one, man.
That's a big base right there.
It's a huge base. I keep pointing this one out over and over again. I know it gets old when you continue to hear people say the same thing, but if you're a good trader, what you should be doing is looking at the same setup over and over and over again. And it should be boring. Trading shouldn't be fun. You can have a good time doing your research and doing what you want, but when you're putting your money into play, that should only be because of one reason. Hey, this is the perfect setup for my system or my strategy. So my buy signal is blank, and that's it. So looking at the Fukushima disaster happened. Basically, I think that uranium, if Fukushima didn't happen, I think CCJ would be, over 100 easy at this point. There's no reason for it to be anything else. But now looking at it, the whole industry gets destroyed, hated completely, and then that bottoms out in 2020. It coincides with the commodity cycle. Then the commodity cycle takes off. 2022, the market goes sideways. It's another thing people don't look at for uranium. It's one of the best diversifiers in your portfolio. That market in 2022 was nasty. CCJ did not get hit. So that's something to continue to look at. So So CCJ breaks out once again and continues to move higher. Now it's sitting above those old highs from 2011 and 2008, 2007, 2008. So if we could kind of break out to the upside here, I think this thing is going to head over 100 pretty easily.
Yeah, I can't argue with that. I
So
love
it's a
this
chart
chart.
for everybody to take home with them. You know, a couple. Sam brought an idea. I brought an idea. So if you guys have a couple trades that you want to put on, these are the areas. Not, obviously this is not financial advice. You have to say that every time. Sorry, guys, but just telling you what we do in our portfolios. I'm a long-term holder of CCJ. I've been holding it for about 3 years now. Sam's looking at that chart that we just showed from Cole. And we'll be on the Gold Rush in just a minute. So if you guys are one of our subscribers to that, we'll see you guys soon. Definitely check out our turn on notifications on our YouTube channel so you don't miss any of these videos. Check out my Substack. It's at AAO Research on Substack. So lots of great information there if you want to stay up on the futures, commodities, and also we have transparent portfolios on there. And definitely check through our videos. A lot of people keep sending me questions about, hey, how do you learn how to trade? Hey, what about the turtle traders? Hey, this and that. All those videos are there with the turtle traders, with all the systems traders. So all of our videos are at AAO Research on YouTube. I know people started to follow us on Twitter, but YouTube's a better place to hold our videos, and they're more organized. So check that out, and we'll see you guys soon.
Goodbye, everybody.